Welcome to Policy on Demand. I'm Krish Chandrasekhar. So far, 2024 has been an eventful year, and 2025 promises to be the same. It's also going to be a big year for tax, and that's what we're going to be focusing on today. Joining me to discuss legislation and regulations are Todd Metcalf, Janice and Pat Brown. Thank you all for joining me today.
Good to be here.
Thanks for having us.
So maybe we'll start with you, Janice. We now know that the Republicans have both majority in Congress and the Senate, but it's been labeled a slim majority. Maybe from your perspective, tell us how that impacts how we should think about tax coming up.
It makes a huge difference.
Got it.
We are a divided nation, and our political parties are very divided. So if one wants to get done a big thing that just your party really wants to get done, you got to get the majority, and you have to have it presidency, Senate, and House. They've just made that threshold, but they have some challenges ahead because it is such a narrow majority. In the Senate, they should have 53 Republicans to 47 Democrats. In the House, we've still got a few races that aren't called. But if the candidate that's ahead right now wins, Republicans may have a majority of 222 to 213. They can't lose many in their own party in that context. And the House already has 30 plus members, Republicans, who don't like deficits and don't want all these tax cuts to just go forward and not be offset somehow. So they've got a big threshold to get over, and President-elect Trump has made it more difficult for them. He's named 3 of these newly elected Republicans to go into his administration. And so you have to reelect somebody in those places when those members resign. One already has. The others may wait a little bit before they have to do that. So the bottom line becomes you can do things, but you have to stay united as a party. They still have to find a way to be united going ahead to get the big things in tax and in other issues they want to get done this year. That will be Republicans only. They have challenges ahead. He's made it a little more difficult for them to even meet those challenges. I think in the end, they could find a way to do it, but they're going to have to parse it. It's not going to be a straight line.
Got it. So then maybe I'll come to you, Todd. So let's talk a little bit about process. One of the biggest pieces that's been getting a lot of press is TCJA expiration. What is the chances, and how would you think about getting something done around the expiring provisions in TCJA within 2025? How should we think about it, given what Janice just said?
So I think it's going to be tough,
Yeah.
Just as it was tough for Democrats to get things done when they had a very narrow majority in the House and the Senate. But it is possible. Now, on the expiring tax provisions, I think it's more than possible. I think it is highly probable they will get something done. It's not clear how long it will last or exactly how big it will be or what the full scope will be. But the one thing that members of Congress, who are all in the House and many senators are up for re-election in 2026, they do not want to begin that 2026 election year with the first thing they've done is increase taxes for virtually every taxpayer in the country. So they're going to get something done.
Yep.
Now, the process as to how they get it done, again, with this Republican trifecta that Janice referred to, is probably they'll use reconciliation, which Democrats have used, Republicans have used in the past, how we got the TCJA. And that magical procedural device is a means by which you can avoid that horrible hurdle of 60 votes in the Senate, the filibuster. But you have to agree on a number. You have to figure out what that reconciliation number, those instructions are. And because the cost of extending these tax provisions is so high, $4 trillion plus probably to extend all of them over the long term, they're going to have to figure out what is my appetite for deficits, to Janice's point. And is it 4 trillion? Is it 2 trillion? Does it need to be offset? Does it not need to be offset? So I think the next several months are going to be focused on reconciliation, focused on what that number is. And once they figure out what that number is, just as we've seen in reconciliation bills for the last 40 years, they're going to figure out a way to back in to that number, whatever they can get done. But I do think they're going to extend, if not all, most of those expiring provisions.
Got it. Makes sense, Todd. So maybe I'll come to you, Janice, on the next piece, which is TCJA has gotten a lot of volume, but there were other pieces too. Actually, there's a very long list of potential other tax policies that were thrown out in the campaign and things like that. But maybe one particular piece that has gotten increased attention is my words, domestic manufacturing, if you will, and made in the USA, domestic manufacturing. Given what Todd just discussed in the context of TCJA, how do those other plans play in, maybe focusing in on the domestic production piece or any other color you want to add about other policies? And
there will be some pressure to fit some of these into that reconciliation bill. They may not be able to fit all of them in. But the one thing we remember when Donald Trump was president before, if he promised something during a campaign, he wanted to deliver something on that. The front runner among all those things, quite honestly, is not taxing tip income. That's very, very popular. So over on the individual side, they'll probably find some, it may be a small package, but some income tax relief at the bottom for tip income. It'll help their distribution, et cetera. But the big kahuna is U.S. manufacturing. He's been talking about tariffs. He's been talking about all these other things to influence that. Now, luckily, there used to be provisions in the code that were incentives for domestic manufacturing. I think the very first thing they'll do, they'll go back and look at those, see how they can fit some of that back in, which is a rate reduction in the way that it is designed. And they will tell this new Treasury Department and Trump, they're answering his call to do that and find the very easiest thing they can to kind of slip into the code as it's been before. Nobody's going to question that as long as they have room in the revenue context of how much revenue do they lose in doing this. So I think they have at least a small answer that gets them through this year's reconciliation bill on U.S. manufacturing, as other things like tariffs and all are being thought about too, being kind of added in. So I think they went, it's something we've done before.
Got it.
So we can potentially do that.
The other thing to think about is obviously there are all these others, no tax on overtime wages, no tax on Social Security benefits, tax credits for caregivers. There's a range of, mostly on the individual side, some on the expanding the research credit, some on the corporate side. But one of the challenges, potential traps that the administration could fall into is Congress saying, well, we're going to do the things that we have to do in the first bill. We'll deal with the new things in the second bill. Well, Janice and I can tell you about the long history of second bills that never come to be. So it'll be interesting to see how they navigate that and whether the Trump administration falls into that second bill trap.
Got it.
Just one postscript I should add on. I agree with you, Janice, on domestic manufacturing. We had a provision in the code for a number of years that actually came out in 2017.
Because rates went way down.
Because rates went way down, exactly, in the TCJA. There is another potential place to look for inspiration for a cut to a domestic manufacturing rate, and that, of course, is FDII. Yeah. I would say we already have a domestic manufacturing incentive. It's limited to exports, but we have one today. And so you could look at FDII and think about expanding FDII, or you could look at the domestic manufacturing deduction that was in the code previously, or you could look at some way to possibly meld those two things together. And so an interesting challenge will be, where do they start and where ultimately do they finish, which is going to be governed by a lot of things, including, of course, revenue constraints.
Got it. So maybe, Pat, we'll come to you. So we've talked about the U.S. lens a little bit, but talk a little bit. It's not like the rest of the world's been quiet in the past couple of years. There's a lot on the agenda. So starting with the OECD's Pillar 2 and I guess both pillars, right. Your take on kind of the global take on this and what we should be thinking about.
Yeah, so I have sensed, Krish, a fair amount of, I guess I'll call it projection going on when I talk to colleagues and companies. For folks who are in favor of seeing Pillar 2 move forward, there's been an awful lot of, well, the EU's got their directive, it can't be changed, this is moving forward, the rest of the world doesn't have to, bend a knee to Donald Trump and the congressional Republicans. That's certainly at one end of the extreme. The other end of the extreme, of course, we've seen a lot of headlines in the tax press, frankly, in the mainstream press, OECD's Pillar 2 is in peril. Is this the end of Pillar 2? I don't think either one of those extremes is actually correct. I think there's a reality here, which is there is an EU directive. Yeah. The member states of the European Union are legally obligated to move forward with Pillar 2. There's also another reality, which is most of the countries that have moved forward with Pillar 2 are in fact in the EU, right? And so this is largely a European project. The world's largest economy, the United States, has not implemented Pillar 2. The world's second largest economy, China, has not implemented Pillar 2. The world's most populous country, India, has not implemented Pillar 2. And a lot of the global South is expressing real, I would say, discomfort almost to the point of disdain for the OECD process generally. Both pillars, of course, they're focused on there. So I think the future for Pillar 2 is one that likely involves some meaningful change, will have to involve some meaningful change. Remember, we're talking about congressional Republicans who last year proposed retaliatory taxation in a measure that was introduced in the House, obviously not enacted, retaliatory taxation on both DSTs and the Pillar 2 UTPR. We're talking about congressional Republicans who have threatened to take the funding, the US government's funding away from the OECD because of the OECD's two-pillar project. So we are really headed towards some pretty serious conflict between these two factions, and these 2 points of view are going to have to find some way to come together in some sort of an agreed approach going forward. It is very unclear what that looks like, but it does seem clear to me as we sit here today that neither the whole thing falls apart scenario is very likely, nor is it's just going to keep moving forward in its current form. So we're going to see some real change, likely over the next 12 months, probably starting with what the Republicans put into the tax legislation as essentially their signal for this is where we are as a country.
There's difference of view even within the firm on how we think about this stuff. There's another video on Policy on Demand with Bill Morris, you got his take on how he thinks about the global agenda a little bit, so feel free to take a look at that. So we've talked about a lot of issues, so let's talk a bit to client priorities then. A lot going on internationally. We're talking about these expectations domestically, provision extensions. What's one or two tips from your perspective, Pat? And maybe we'll go across of how should the tax function think about using their resources over the next 6 to 12 months and thinking through, if you will, the action, the chaos, depending on your point of view, so that they're productive over the next 3 to 6 months.
Yeah, so
what's your tip on that?
I'm going to start with something outside of the tax code, and that is tariffs.
Fair.
President Trump has been very, very clear, not just that he's going to do tariffs, but that he wants to do tariffs to change behavior. Yep. He wants to change the action on the part of businesses choosing where they manufacture, choosing to manufacture more in the United States. Obviously, this is tied to the domestic manufacturing incentive that the president has talked about. So that is going to change behavior. If President-elect Trump is successful, that will change behavior. That will obviously have an impact, direct impact on companies that are affected by tariffs. But frankly, there are going to be a lot of downstream impacts as well. So what will be the effect on the Chinese economy overall, which is obviously very much in his crosshairs? What about some of the effects in some of the other countries that could be winners or losers in this space? And of course, as we look at the perspective of each individual company, how will this affect your operating model? And that can be true whether or not you're an importer or an exporter of goods, because again, some of these downstream impacts that could have broader ramifications for the Chinese economy. So I would start there and actually ask the question, how is my company going to be affected as a result of changes, tax or non-tax, to kind of the global landscape when it comes to the flow of goods and services? And
you've often reminded me, Pat, that in a lot of cases with our clients, the tax and the trade responsibilities are in different places. Exactly. So if nothing else, open that line.
Exactly.
From your perspective. Yep. Janice,
that was exactly where I was going.
Got it.
Companies work together within yourselves. Don't have silos right now. You've got too many things going on in too many areas, and I'm sure it's beyond just tax and trade issues. Definitely work together to think about your future, because your supply side chains, these other things are going to affect your taxes. And you're suddenly going to have saved yourself over here on taxes, on tariffs, and not helped yourself at all on the other. But just be alert. You learned in that first administration that Trump had that you have to expect the unexpected right now. You have to plan for these things that have been proposed, but someday's going to come, if a company's moving something to Mexico or not, you've got to be prepared right now for that scenario to kind of go against you. And how do you protect against it the best you can?
Any final thoughts, Todd?
I agree with what they said, but I would just say that because of all these changes and because Congress is going to be acting either in your best interest or against your best interest, to the extent you have relationships with members of Congress, you should refresh them and renew them and reinforce them. And to the extent you don't, now's the time to be developing them.
Got it. So thank you, Pat, Janice, Todd. Really appreciate your time today.
Thank you.